is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott, here with Andrew Young. Andrew, we talk about these different protocols all the time. Ethereum is one that we spend obviously a lot of time focused on. And last year, we recorded several episodes in the lead up to the merge. And we were talking about how that was going to be a very big catalyst for Ethereum, but also for Web3 more generally, that the largest smart contracting platform was moving from proof of work to proof of stake, and how that was really sort of setting the stage for this next era of app development, and also potentially enterprise and corporate adoption of these underlying technologies. But we've never actually had someone from inside the house on the show to talk about it. We've had people building dApps and related entities, but never someone from Ethereum. And so I think the time has come for us to have that conversation. We're very fortunate today to be joined by Tim Beiko, who's a core developer and a key figure in the Ethereum Foundation. As I mentioned, Ethereum is the community-run technology that's powering Web3. The network supports thousands of decentralized applications, billions of dollars of digital assets, and trillions annually in transaction volume in the native cryptocurrency Ether, but also in the assets of many different kinds of applications and other kinds of assets like NFTs, for example. Tim was a key figure in rolling out the network upgrade known as the merge, which was the move from proof of work to proof of stake, something that a lot of people were eagerly awaiting. Some were skeptical whether it would happen, but it was pulled off without a hitch, which is kind of remarkable, sort of like swapping out the engines of a 747 mid-Atlantic flight with 200 billion or so of cargo without really upsetting the flight plan or even the drink cart. So quite an accomplishment. And what seems really interesting, at least recently to me, is that Ethereum's not like resting on its laurels. It's not like we've got the merge done and now things are good. And if anything, it seems like the upgrades to the network and the news is coming fast and is quite exciting as well. And so I think now is a really appropriate time to talk to Tim to kind of do a debrief on the merge, but also to talk about some of these new network upgrades and other sort of milestones that are in the pipeline. So just really excited about this episode. So Tim, thanks so much for joining us.
Thank you for having me.
So I kind of previewed some of the topics that we want to cover on the show, and hopefully we can get it all done in the time allotted. But can you just tell us a little bit, how did you get into crypto, into Web3? We're always curious to hear people's origin stories.
Yeah, sure. So I had a friend tell me about Bitcoin. I think it was like 2013. Got slightly interested about it. I think I bought like one Bitcoin at the time and didn't do much beyond that. But I sort of knew it existed. And kind of kept tabs on just like cryptocurrency, but it wasn't my main thing at all. And then similarly, when Ethereum came around, I sort of heard about it, but didn't like dive all in or anything like that. And the thing that actually got me a bit down the Ethereum rabbit hole was the DAO. So the DAO, for people who don't know, was like the first big project on Ethereum. The idea was that Ethereum is like this smart contract platform where you can execute like arbitrary code and build applications. And financial applications are like really well suited for it because it sort of runs, Ether like as a currency on the network. And so the DAO, the idea was like you could pool all this money together in the form of Ether, give people a token representing their claim about that, and kind of run a sort of on-chain VC fund where like all the people who got, if I pooled 10 Ether, then I would get, a share of tokens that represented that. And then if the DAO wanted to invest in a company, there would be some sort of vote like that. So it seemed like a really exciting project. I bought some Ether to literally invested in the DAO. And about 2 days after that, the DAO got hacked. So the DAO, I think it had raised $100 million or something like that, some really big amount. But at the time, it represented about 10% or so of all Ether in circulation was in the DAO. So people were very excited about this. But then it got hacked. And so somebody found a way to basically drain the whole thing. So that's really sort of what pulled me down the rabbit hole, where it's like, the first interesting project I invested gets hacked. And sort of forced me to understand, like what is actually this thing, beyond just like sending money and getting my tokens back, what's happening here.
Right.
And so as the hack happened, after that, there was the second thing that happened where the Ethereum community got together to sort of fix this hack. There were a bunch of like subtleties about the DAO that made it possible to like recover the funds that were hacked. But a part of the community disagreed with that approach. They thought the whole kind of code is law thing should hold, and that the hacker had only used the smart contract as the code allowed them. So the network actually split in two at that point. So there was Ethereum and Ethereum Classic.
Yes.
And that was another kind of big lesson in like, okay, like what's happening now? I had coins on Ethereum, I had coins on these projects, they got hacked, but they're going to be, returned, but then the network is splitting, and now there's this other Ethereum Classic thing, and I have coins on two blockchains now, but if I do a transaction on one, somebody might like steal my coins on the other. So it was like this whole process of, understanding what is like the technology that this stuff works on. And then after the DAO sort of happened and this whole debacle kind of went through, Ethereum was a bit more, I'd say, dead for like 6 months. Not much was happening. There was kind of this like fear, like it's like, look, we built this smart contract platform. We can't build smart contracts on them without getting them hacked. Like, is this a valuable thing to have? I think that was my perception, right?
Yeah.
And then you started to see, this was like 2016, by the end of the year, you started to see some new projects, come on and start to use Ethereum to launch and to run new things. And that kind of got me interested again. So late 2016, early 2017, it became clear that like there was demand to use Ethereum to do types of things. And even if like one specific project failed or, most of them failed, there would probably still be like another batch at some point that came in and did something and did something interesting on the network. But in using the network at that time was a pretty bad user experience. Like if anyone's used Ethereum in like 2016, 2017, like if there was like some big, ICO happening, the transaction pool would get stuck for like days. Your transaction would be pending. You had no idea, if you'd gotten in or out. Wallets were like much, much worse than they are today. And that kind of got me wanting to work on the protocol itself, because it felt like, all these projects being built were like very speculative. I don't know that I wanted to take like a bet working for any of them, but I was like, clearly the network underneath, there's demand for that. And so I started to want to do that. I was a product manager. It was kind of hard to get a product manager job working on a protocol because protocol is not a product. But luckily, in 2018, Consensus started a protocol team, and we're hiring product managers for that. So I joined Consensus's protocol team, worked on their Ethereum client, which is like the software that people use to connect to the Ethereum network. Did that for a couple of years, and then moved over to the Ethereum Foundation in late 2020, where now I basically help coordinate the different Ethereum clients around everything related to protocol upgrades. So yeah, kind of a long-winded story, but slowly got pulled in the rabbit hole. Over time.
Well, it sounds like there were a couple of times where a lesser person would have been discouraged and walked away. But it seems like almost like the more problems there were, the more interested you became in it, which is probably the kind of person you want as a core developer inside of a protocol, someone who's drawn to problems and wants to fix them. I was really interested in your comments about the DAO, because that was also, I think, a really pivotal moment for the Ethereum network and for the Ethereum community. And I suppose it's true that the network did split into two, but the canonical Ethereum, the internet of value that we know is Ethereum, and then there is Ethereum Classic. But most people assets, and I think the sort of the spirit of the thing continued on in one version of that. And struck me as this very interesting sort of like initial governance challenge that was addressed. And some people have found fault in it, but I personally think is the thing that kind of saved the network. So sort of going fast forward to today, the Ethereum network in those initial days in 2016, they talked about the move to proof of stake as being part of the roadmap. And that move was delayed a few times. And I think a lot of people were questioning whether it would happen, especially as the network became so much more popular. There was more at stake, right? There were more assets, more applications, more people depending on it. And the idea of like changing it over seemed, more and more daunting, I think, as it became more and more successful. And yet we know that last fall, the merge went ahead and was done, very successfully. So from the outside looking in, the merge almost seemed uneventful. Weirdly, it was one of these things where I think everyone was really stressed, and then it happened, and then things kind of moseyed on, continued on without incident. But there must have been a lot going on behind the scenes. Can you tell us, what was it like from the inside in the lead up to that big moment?
Yeah, for sure. So I think I'll agree with you that the actual moment was uneventful, which was surprising to me. So my job is, to coordinate these things, and my expectation was something would happen, right? And I'd spend the next, day to week helping fix whatever that was. And literally nothing happened. I think, it exceeded the expectations of, or at least met the most optimistic expectation of anyone working on it. So I think it was hard to do better than that. And the reason for that is basically I think in the year leading up to it, we pretty much exclusively did testing. So the merge took a long time to happen, and can get into the whole technical roadmap. But at a high level, there were just many iterations of the design that sort of weren't good enough. And I think that's been the entire philosophy is just we came up with an idea, then found that it was broken in some way or another. Rather than ship this thing that's broken, we sort of went back to the drawing board and okay, can we make it better? Can we make it better? And a lot of times making it better, sometimes it makes the system more complex. You add some conditions or some fixes to something you weren't aware of. But I think over the last year or two before the merge, it was much more the opposite. It was much more about making it simple. Okay, we have all this complexity. Is there a way we can reduce as much as possible? And this is what got us to the specification for the merge. And the first time, so we merged in September 2022. The first time we had a prototype implementation of the merge was May 2021. So in May 2021, we had an implementation of a post-merge prototype, basically Ethereum runs now, proof of stake and the execution layer underneath. We spent the entire summer of 2021 fixing those. And then we got together in the fall of 2021 to prototype the actual transition. There's a network on proof of work, there's a network on proof of stake. We bring them together. Does this work? And again, we got that to work in the prototype in October 2021. Spent the rest of the fall fixing it. And in January, we had a spec that I'd say we were 85, 90% confident in. So we launched a new testnet using that. We spammed it, asked a bunch of infrastructure providers and applications to use it and try to break it, and we found some sort of edge case issues. Nothing critical, but just some parts of the specs that could be hardened. And in March, we launched another testnet that was to sort of fix all of that. And so you can think of this entire period from March to September as only testing. From that point on, the specification was basically frozen, and all of the client implementation. So Ethereum basically has a written specification that many teams implement in production software. So from March to September, it was basically all those teams, fixing bugs in their specific implementations, but there were only very minor changes to the actual spec. And so I think that's kind of the thing that made it, so smooth is we literally spent over a year prototyping and testing it, and a solid 6 months only testing it, where every week we would run through some sort of fake mini merge with all the current software, see what breaks, fix it, run it the week after, see what breaks, fix it. And doing that over and over again, I think is what, got us to a point where we were very confident in the quality of the software. And obviously I think everyone took this extremely seriously. No one wanted to see the entire network go down because of a bug that they introduced. So yeah, it was just a lot of testing for a pretty long period of time.
Yeah. And I think and the merge has been a huge success. I mean, we're at over 500,000 active validators now. And I'm not sure the exact amount that's been staked. I think it's over 20 million.
Over. Okay, yeah.
20 million ETH now, I believe, or roughly around there, which is a huge percentage of the active ETH. One of the sort of criticisms, I guess, post-merge was around centralization risk. particularly with sort of the liquid staking protocols, things like Lido, which we've covered a bit on this show. I'm just curious what your thoughts are on that, and whether you think it's a big concern moving forward, or something that will kind of get naturally worked out over time.
Yeah. So I have maybe different opinions than like other core people on this. So, just very much want to caveat, this is my view. It's not like the view of the EF or like, the core protocol people. But so first of all, and I think everyone would agree with me on that, like we want a diverse set of stake on the network. And the way I sort of explain this is like, people always use the word like decentralization, but it's quite hard to like explain what that actually means. The way I think about like what it means for Ethereum to be decentralized is you want to have decorrelated failures, right? Like the network is designed in a way that it's resilient to some part of the network going offline, because anyone can run a node, because we expect this to be over the world. We don't have an assumption that like 100% of the network needs to be online all the time for things to work. We expect about 2/3 to be there at a strict minimum. If there's less than 2/3, the network still runs, but it's kind of in a degraded state. But anything over 2/3 is good enough for Ethereum. And the network also has all these like economic rewards and penalties that are effectively based on this. Like if you do something wrong and you're the only person doing something wrong at that time, you get a smaller penalty than if like 30% of the network is doing something wrong at the same time as you. And the idea there is like, can we push people to have setups that are decorrelated from each other? So from there, every sort of correlation you can imagine in the validator set is some sort of risk, right? Like if all the validators on Amazon Web Services and AWS goes down, then that's bad. And they'll get penalized more harshly because of this correlation than if they were split. And so, the main criticism that you see of things like liquid staking is that, like, yes, they are, a centralizing vector, right? And there's many ways in which they can be centralizing, and I think the best liquid staking protocols like spend a lot of their efforts trying to minimize those things, whether it's through, geographically distributing the node operators, minimizing the governance that they actually have on the network, and things like that. So I think when it comes to like, are these things good or bad? I don't think they're good or bad in and of itself, but it's always like relative to the makeup of the rest of the stake. So you can imagine like two worlds. One is like where, if there's no liquid staking, everybody's staking on like Kraken, Coinbase, and Binance, then obviously the world with liquid staking is like much better, right? Like, because you've taken like market share away from them. But then you can imagine the other world, which is like, if liquid staking wasn't there, all those people would be staking individually in their homes, and they would be even less correlated and even more decentralized, and that would be better. So I think the question, with liquid staking is just like, do you think it's pulling from like centralized exchanges and putting it into something better, or do you think it's like pulling from like independent validators? And obviously it's hard to answer that question, but I think this is where like people who are like very for, very against, kind of this is like the case that they'll make. So I think they are important. I think that said, as someone working on the protocol, I feel like it's kind of our job to make it easy, or easier at least, for people to stake, independently. And like it's not like the easiest thing right now, right? Like I think there's many ways we could make it easier. It's not impossible. Like I think anyone who has like some decent technical understanding, like if you're able to like use the command line on your computer, and you need about give or take like $1,000 ish of hardware, sort of like I think 20 megabyte internet connection, and the 32 ETH obviously. So it's like it's not an impossible barrier, but I think there's a lot we can do in terms of UX, in terms of just like node requirements to help reduce this, and that would be better for the network. But in the meantime, like if instead of the marginal person staking on Binance or Coinbase, they go and they stake on Lido or Rocket Pool or Stakewise, then I think that is net better. Yeah.
Yeah, for sure. And everyone worried about the centralized exchange taking over just because of the easier UX. Obviously, the liquid staking pools are huge for that. I do want to shift a little bit to looking forward. You announced yesterday that the Shanghai Fork was successful on testnet yesterday, I believe.
Yeah.
And the big thing with the Shanghai Fork, obviously, is it allows people who've staked to withdraw. I mean, there's a bunch of other obvious things there too. But so I'm just curious, can you explain kind of for the audience what happened yesterday and why it was such a big deal?
Yeah, for sure. And I think I'll start by explaining, like, this withdrawal thing, just to make sure it's clear. So as I was saying, like way earlier, when we were working on the merge, we tried to simplify things as much as possible to like reduce technical risk. And the biggest feature we cut basically was the ability for validators to get their stake back and do something else with it. So since the beacon chain launch, this has always been like a one-way process. So you can deposit your ETH, become a validator. You can stop being a validator, but even if you do, then your ETH is still kind of locked on the beacon chain. And obviously, people want to withdraw that. And just because of the complexity of the merge, we decided to like not add this functionality at the same time. And this is now the main focus. So like what we're working on right now. And so, like the merge, testing is paramount. So we've spent the past few months testing this, and then Ethereum has like these test networks that are basically a copy of Ethereum, where applications can deploy before they deploy on mainnet. And client developers and protocol developers basically use them as well. So before we publish an upgrade to the main Ethereum network, we run it on a couple test nets and make sure everything works as expected. So we have two test nets. And yesterday we upgraded the second one. So it seems to have gone relatively well. And assuming we don't find any issues, so like today and the rest of yesterday, people were sort of looking into it. Then we'd go ahead and schedule the date for the main Ethereum network to upgrade. And so once that's live, basically anyone who was a staker can choose to like fully exit, get their money back, and go on with their lives. But also people who remain stakers will get their rewards automatically withdrawn. And by withdrawn, it means basically sent to an Ethereum address that they can use in DeFi or whatever, without needing to stop being a staker.
So the conventional wisdom there is that once once they're free to sell, then they'll sell. When probably, at least in my view, the opposite is true, which is that people maybe who are on the fence about staking will stake because it's liquid. And so like actually probably like the net, there's going to be a greater share of supply staked, because the idea that like you can stake and passively earn Ethereum income is extremely attractive, I think, to a lot of people who hold the thing.
Right. So obviously you're sort of closing some sort of like, arbitrage or you're making the entire loop possible. So like people don't feel like they're locked in for some like undetermined period when they stake. And the thing that's worth noting as well is like, if, imagine a lot of people stop staking after this, they just want to sell and move on. The network stake incentives basically go up or down based on how many people are staking. So if a bunch of people like stop staking, then the rewards to validators just go up as a way to attract stakers. And then if too many people are staking, they go down. So that's not something, I'm too worried about. Like if we lost a bunch of stake, then the rewards go up. That maybe incentivizes other people to stake, and vice versa. Like if everybody piles in, the rewards go down, and that maybe disincentivizes people to stake, and we reach some sort of like equilibrium.
Yeah, and then I'm just kind of curious, taking a longer term view. How do you think of sort of Ethereum's maybe not tokenomics, obviously, but we'll call it value capture or economics moving forward? Do you think, I guess I'm just curious what your thoughts are on sort of the sustainability of this model. Ethereum's obviously I think it has by far the highest sort of fee capture of any blockchain now. Yeah. If you go to sites like Token Terminal, it's not even close. And so that's obviously amazing, but I'm just kind of curious because obviously the fee markets itself within Ethereum are highly volatile. If you have a popular NFT mint, fees can sort of 3 or 4x overnight. So I'm just kind of curious your take on maybe not the sustainability, but more kind of the economics of the Ethereum network moving forward in a post-merge world.
Yeah, of course. So, and it's worth maybe explaining just for the listeners, like high level what are the economics of the Ethereum network?
Yeah.
And we can
And Tim, in answering that question, can you also just talk about like the burn feature and like how the supply kind of evened out, and this notion of like ultrasound money, just like kind of try and capture those concepts?
Yeah, of course. So I think so I like to like kind of break it down, individual parts, and then it makes sense to kind of put it together. But like if you think of Ethereum, so it's it's a blockchain, and the thing that we want to do is incentivize validators and previously miners to like keep building the chain in an honest way, right? Like if you can think of like Ethereum as a product for a second, we're selling like secure block space. So it's like important that the next block comes quickly, it's reliable, it's secure, it doesn't get reorged, and things like that. And proof of work, the way that you use to do this is that you give people like a huge amount of money to do the honest thing, and you hope that because of the opportunity cost of like defecting, they keep doing that. But you have no way to like penalize people who, reorg a block or, start their own competing chain or whatnot. Proof of work is really just like a huge carrot that you put in front of miners, and that hopefully pushes them to do the right thing. Proof of stake is interesting in that like we can keep rewarding people for doing the right thing, but because the stake that they use is in the protocol, we can also apply penalties if they do the wrong thing. Like if they're offline, if they sign conflicting histories, they basically contradict themselves, things like that. We can then go and like apply a penalty as well. Whereas in proof of work, it's like you'd have to like, have the protocol go and like shut down somebody's miner, which is just not feasible. And this means that we can effectively like lower the rewards a lot. Because if you think of this as like, some sort of like incentive window, if you don't have any penalties, you need to put a huge carrot in the form of like issuance of the network, and kind of hope that works. If you can have both rewards and penalties, then the rewards can be much lower because you sort of bounded the like negative actions with penalties. And so in practice, what this means is that for Ethereum, going from proof of work to proof of stake has reduced issuance by about a factor of 10. So I don't know the exact numbers now, but like right before the merge, we would issue somewhere between like 15 and 20,000 ETH for proof of work rewards per day, and we would issue about like 1,500 to 2,000 per day for proof of stake. And so, another way to think about this is like, imagine, proof of work and proof of stake are like security systems that you pay for. And proof of stake is just sort of a new one that's like 10x cheaper and gives you like, similar features and whatnot. And so if you think of like, ETH as an asset, this is obviously sort of less dilution that gets applied to the network by moving to this new consensus mechanism. The other part of like the Ethereum economics is everything around the burn and transaction fees. So this is kind of a weird thing in that Ethereum today has what we call a base fee. And you can think of this as like a market price for the cost of like a transaction. Like at this moment in time, how much should the network charge you to transact? And this basically goes up and down based on demand. So if more people want to make a transaction at the same time, the blocks get more full, the market price goes up. And then if less people, want to transact, the blocks get empty, the market price goes down. So it sort of stabilizes over time. And for like economics people, like one way I've thought about it is like, it's almost like surge pricing on Uber, but it goes in like both directions, right? Like there's no floor, or the floor is like zero, right? Like if nobody wanted to transact on Ethereum like ever, then, the price would be zero. But if everyone wants to transact at the same time, it goes like up exponentially quickly and down exponentially quickly if everyone goes away. One like requirement for the signal to be good is that you need to basically burn the amount of transaction fees that correspond to this amount, because otherwise miners or validators would just fill the blocks with transactions, raise the price on everybody else, but then they get back their transaction fees as a miner. And so it would kind of break the entire system. And so you don't actually have to burn the fee. You can do whatever you want with it, as long as you're not giving it back to the miner. But just for simplicity, Ethereum chooses to burn this. So when you put these things together, it means that like, after the merge, Ethereum has moved to a world where like the amount it needs to pay to secure the chain has gone down quite significantly. Mm-hmm. And this other burn was like before the merge, but this is like August 2021. since then, when there's more demand to transact on the network, the amount that it costs to transact go up, and the amount that's burned goes up proportionally to that. And so this means that basically the ultrasound money meme comes from this. So, Bitcoiners like to say that like Bitcoin is sort of sound money because it has like a fixed supply, and no one can create more than the inflation schedule, and it has all these happenings, as part of the emission. So the ultrasound money meme is that, the merge issuance reduction kind of was the equivalent of like 3 Bitcoin halvings, right? Where it went down 90%, all in one shot. And then because we also burn fees, if the amount of fees that's burned is greater than what's issued to proof of stake validators, then you get Ethereum as like, being deflationary during that period, or like, having net negative issuance.
Yeah.
Andrew,
you want to hop in, because I want to follow up on this ultrasound money concept. So it's a great meme because it does sort of like invert the perception, I suppose, of these different kinds of assets. But it's also worth mentioning that the supply today is actually lower than it was in September at the merge. So that process that you just described, where the fee burn is in excess of the new issuance has actually begun to occur, right? And so we're in this environment now where $9 billion worth of ETH has been burned. The actual sort of net change in outstanding is much more modest than that, but still it's lower than it was in September. And in that same period, $5 billion of new Bitcoin was created. So from an investment case, you could say, okay, then ETH is this ultrasound money. It's deflation. It's useful as a platform. It's seeing tons of adoption, even in a bear market. And, our denominator is going down, right? So it's like cool stuff on top, and then above the number of ETH outstanding, like the more cool stuff happening and the less ETH and the more value like per ETH, right? But like from like an economics perspective, and I'm not an economist, but, there's sort of this notion that if you think of these blockchains as economies, there's an argument to be made that some kind of new emission of the currency is good for sort of facilitating, trade and investment and spending and so forth. I don't know if like this is a topic you're interested in at all. Maybe it's sort of not. Yeah. It's not something you are, but I find it interesting because we do look at this from an investment case, and it's like, is supply decline really good, or is it sort of agnostic? Right. Like, do we care? I don't know. I'm just wondering what your thoughts are on that.
Yeah, and I think so. This is I think I sympathize with what you say. I think this is why it's important to break like the burn from issuance, because like we do keep increasing the supply, right? Like unlike Bitcoin, ETH plans to like keep paying validators forever, right? Like and when I say ETH, I mean the protocol itself, right? Bitcoin has this kind of thesis that over time, transaction fees are the only thing that like rewards miners and block rewards are not. Ethereum, I think philosophically disagrees with that because, the chain should be secure, whether or not there's like some NFT drop happening on it right now, right? Like it's, and if transaction fees go to zero, the amount we give out to validators should, secure the network. And this is kind of what, again, if you think of it as a product, it's like, the cost to like build a good product. Like you need to pay for security if you're selling secure block space. And this means there's always going to be some amount of issuance, right? Like the protocol itself does not like optimize for deflation, if that makes sense. Like, we optimize for like paying validators to secure the network. And then obviously if usage exceeds, whatever that amount is paid, then, the issuance becomes deflationary. And again, this is like stretching the analogy of a product a bit, but like you can think of this as like the Ethereum network making an investment in security, right? Like in the form of issuance. And then it might recoup that investment if the block space it sells, offsets its like cost of issuing that secure block space. Right. So it's like if consumers who are like the users using the block space, value it highly enough to offset fully the expense, then you can think of it in like a rough way as like, they've like have a positive ROI on the security expense. But I think, and this is why I think it's like a different framing than just saying, like, oh, we're going for deflation. Like
Right.
deflation is not really like the goal in and of itself. It's a potential consequence, but like you could imagine a world where like if activity halves, like the fees have overnight and like we're not deflationary anymore, it would make no sense to lower validator rewards because then you'd make the network less secure, right?
Yeah.
And so I think when you separate it that way, to me, it seems more like sound than just saying like, yeah, we're going to optimize to like burn as much ETH as possible.
Yeah.
I don't think that should be like a goal in and of itself.
Yeah. It's like thinking of it, you mentioned a couple of times thinking of it as a product. I mean, if it's a company and they're providing some useful service and they're sort of earning fees in excess of what it costs to provide them, then they buy back stock, and that's like accretive. But it doesn't mean that the thing is useful, right? Anyway,
it's kind of weird.
I'm a TradFi person by background. So I always default to these metaphors I understand.
And it's kind of weird because like the they in your sentence, because it's like the network itself issues new ETH to pay for security, but it's not the network buying back the stock in a way. It's like the consumers, which is like where the analogy with like a stock buyback breaks down, right? Because it's not Ethereum itself buying back. It's like the users paying, and the network captures its value through the burn. But it's, it is close to like a stock buyback, but it's also, there are like some subtle differences where like, Ethereum's obviously not a company.
Yeah, for sure. And one thing that is kind of interesting talking about all this fee capture is one perspective in the market that I think both myself and Alex do not subscribe to, but it seems to have been a big narrative, was about how L2s could theoretically sort of cannibalize fees from mainnet Ethereum and potentially sort of wreck the security model of mainnet Ethereum by cannibalizing sort of the fee market. From what we can see, it seems to increase it because you know what I mean. It just allows it. It creates more growth for Ethereum, and then also leads to more sort of bridging between them. I'm just kind of curious because we're now up to, I think, 25 different L2s on Ethereum with over $10 billion now of TVL spread across all of them. I'm just curious if there's any specific projects in the space that you think are particularly interesting within the sort of L2 space, and then also just kind of your perspective on L2s and how they can kind of help Ethereum or hurt them in different ways.
Yeah, of course. And I'll start maybe with your second question, which will help kind of, get into more specifics after. But I think at a high level, so again, if your listeners don't know, like L2s are basically, can think of them as copies of Ethereum, and they run in parallel to the main chain, but through some cryptography and economic sort of tricks, they manage to like keep most of the security from Ethereum layer 1. And the idea there is that obviously a lot of people want to use Ethereum. When that happens, the fees get very high, so not everybody can use it at the same time. You price out a bunch of users of use cases. So layer 2s are sort of the strategy that Ethereum has kind of moved towards to enable more people to transact with the security kind of guarantees of Ethereum without having all those transactions land on the main chain, which is like heavily limited in terms of throughput. With that analogy, like you can think of almost like users moving from L1 to L2s as like Ethereum going from like a B2C to a B2B kind of chain where, today most people by default transact on Ethereum L1. Obviously you can use Ethereum L2s for a bunch of stuff, but like when you open your wallet, like you're sort of on Ethereum L1 by default. And you choose to bridge over to L2. And layer 2s, basically what they do is that they have all their transactions happen on their chain, and then they'll publish either a proof of those transactions or some compressed data that sort of summarizes those transactions back to layer 1, and they'll pay gas fees for this. And I think over time, what you're going to see is that as more and more users kind of default to layer 2, as these become sort of more stable, more secure and whatnot, the usage of Ethereum layer 1 will probably start going down in terms of like an average user. And the users will then be, all of these layer twos who need to post back data to Ethereum layer one to sort of secure their chain. And you might think, of like large, exchanges settling balances between them. Maybe, the most expensive NFTs end up always being on layer one. But these kind of like very high value use cases where users are much more like price insensitive, or, things like oracles, right? Like the Chainlink Oracle. All these users, like, they need to post to Ethereum L1 no matter what, right? Like Chainlink needs to update the price of ETH and every other asset that it links every, interval, regardless of the current price. These layer twos need to post a batch, every, n minutes or n hours, regardless of the current gas price. And this is where I think, like, in terms of like value capture and whatnot, like obviously Ethereum like shouldn't be some sort of like rent extractor, which like, sort of tries to gouge users and, keeps having higher and higher fees. And then that'll just mean people move elsewhere anyways, right? Because they can't afford the fees. So these layer twos, what we're able to do is like provide much lower fees to users and then have these layer twos, which are, effectively kind of enterprise users, pay for block space on layer one to secure their chain, have other sort of significant infrastructure projects keep doing the same thing. And I think over time, like, yeah, we'll shift to a world where like most of the usage on L1 is coming from like, whether it's layer twos, whether it's oracles, but like these sort of like more enterprisey things. Users will be able to transact fairly cheaply on layer twos. And like Ethereum layer one also, like with regards to just the security, because we issue, the Ether to validators regardless of transaction fees, like it doesn't become less secure. So if there's like a weird transition, imagine that like people move to layer twos, it's like less fees on L1 and not quite enough usage from L2 to like match the previous level of fees. Layer one is not less secure because like the issuance hasn't changed. Like we might burn less ETH or burn no ETH for a while, and that's fine. But the security of the network is unchanged. Yeah, so I'll pause here and then we can get into specific projects if you want after, but just want to make sure that's clear.
Yeah, no, that's clear. The one topic I really want to drill down on before we go is this recent proposal to do account abstraction or wallet abstraction. It's sort of a word that conceals, I think, the true meaning here. But basically, I think the promise of this is that it makes it maybe a bit easier for a mainstream user to sort of get used to using blockchains. I think of that as sort of the big outcome of this. And can you just like kind of explain what's the status quo? What would the world look like with account abstraction?
So the biggest challenge for like using a blockchain as a new user, especially today, is you need ETH to pay for fees on the network, right? Like ETH is like the main reason it exists is to pay for transaction fees. But most people who like are very new to blockchain, first of all, may not even want ETH, right? Like if you're buying like an NFT, you're buying an ERC20 or you're playing a game, you want the NFT. You don't care about this random like Ether token in the background. Like, why would you need that? Right. And so in terms of UX, it's pretty bad today. Like, so for example, if I'm like a new user, I want to buy an NFT. I need a wallet that needs ETH in it, but then I don't even know what ETH is. And so I have to go down this rabbit hole of like, okay, I need to like download MetaMask, buy some ETH, send some ETH to my wallet. I still haven't gotten my NFT. I don't even know, why it's taking so long to come into my wallet. And then, you go through this entire like onboarding process, and then maybe 30 minutes later, if you're lucky, you get to buy your NFT. And that's kind of a really bad experience. Account abstraction basically allows the project creator or whoever is like running, whatever product you're interacting with, to basically abstract the fact that you have an account. So to like, not even expose that to you as a user and to pay fees on your behalf and kind of like optimistically, say submit a transaction for you to get you your NFT. And then only if you've actually gotten your NFT, then maybe they've subsidized the fee for you to buy that. Maybe they've like charged it to you in fiat or whatever, but they've handled all of that in the background. And then at the end of like your user flow, we're like, okay, you get your wallet, but there's your wallet with your NFT in it. All you did was like, buy your NFT like a normal, consumer product. And this is kind of the idea. There's more complicated flows you can do with account abstraction. There's a lot of things around trading and whatnot. Like for example, imagine you're selling an ERC20, for ETH, maybe you don't care, does the trade happen on like Optimism, on Ethereum, on Arbitrum or whatnot? Like you just want to get the best price for, your token going to ETH. Account abstraction kind of helps you with that as well, where you can just say like, look, this is like the intent I have. Like, I just want to like sell this thing to that thing. I don't even have ETH, right? Like maybe, I'm selling this NFT that I bought on Arbitrum. I want to get like, Matic on, or I don't know, some other like asset on some other chain. You can have all of that basically happen in the background without requiring like a user to have a wallet with ETH that they need to sign transactions with and whatnot. And then, but then at the end of that flow, you can kind of give the user their access to their wallet and whatnot. So they still get the self-custody out of it, but you've just like managed and abstracted this whole complicated part of like interacting with the chain and the sort of 5 or 6 steps that takes you the first time to like onboard and get ETH in your wallet and do the thing you actually want to do.
Yeah. Well, to me, it's a really exciting opportunity. And it's something that a lot of other technologies throughout history have done to just make it easier, right? To access things. Like, if you were using the web in the 90s, you had to buy a modem and you need to tie up a landline, and you needed, even like using a web browser was very difficult. There were no search engines. You had to type in the URL exactly correctly. And if you didn't, then nothing would happen and you would get an error message, and then websites would freeze and like all this stuff. And it's eventually, it just became easier. Like it abstracted away all that technical stuff and made the user experience much more rich and just easier to use. So like, I think that's very logical, like as a next kind of step for Ethereum, right? Yeah. That's a great way to end it, Tim. This has been an awesome conversation. Thank you so much for being so generous with your time and insights. You have a real knack for explaining this complex stuff in really simple and easy to understand ways. I think our audience probably benefited a ton from those explanations. I know I certainly did. I learned a lot from this conversation, as I did the last time we spoke. So it was a real pleasure. Hopefully we can have you back on again soon. That's it for this week's episode of DeFi Decoded. We will see you next week. We've got a killer lineup of guests for the next sort of like 6 to 7 weeks. I went on an emailing rampage, and so we've got a murderer's row of awesome people joining us. So make sure to tune in next week. That's it. Take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.